Hi, professional and all. This is Muhammad Abdul Wajid Qureshi. I am going to give a presentation on 6.5 assignment mini case study for financial information for Fresnel new venture and advice, which I divided into five major slides. They are as follows. Number one, introduction. Number two, aspects of performer income statements. Number three, aspects of working capital analysis. Number four, aspects of free cash flow and discounted cash flow. Finally, the fifth slides will be on formal documentation. Let's start with introduction. Introduction. Capital budgeting is a crucial financial process that Freshnel Enterprises Inclusive is undertaking as it venture into a new collaboration with manufacturing partner in China to produce an innovative line of screen goods smartphones. The company already adopt a design, marketing, and distribution in the United States recognize its limitation in manufacturing expertise. To address these, Fresnel has strategically engaged a contractual manufacturer in China, where it will be invest the necessary capital to set up production and assembly lines. The financial landscape of this venture is categorized by various key components. Fresnel spent $150,000 on design throughout project conceptualization and planning. The equipment cost $675,000 and depreciates $135,000 annually. After 5 years, all sets will be fully depreciated. Now, the major the second slide, which I am going to explain Fresnel Enterprises inclusive income statement. Okay. The performer of income statement provides a comprehensive overview of Fresnel Enterprises Inc. expected financial performer over the 5 years of the new venture. Let's break down and analyze the components of the statement for each year. Important aspects you can see in important assets. The first I'm going to explain for sales. These sales figures represents the projected revenue from the sale of the smartphone screen cards. The declining trend in sales from year 3 to year 5 may raise concern and warrant further investigation into market condition, product demand, and competitive factors. Next aspects for this income statement: selling and administrative expenses. First to year 5, $95,000. These are the fixed operating expenses associated with the selling and managing the product. The consistent nature of these expenses indicates stability in the company's operational overheads. Third one, depreciation. Constant at $135,000 for each year. Depreciation reflects the allocation of the initial equipment cost over its useful life. It remains constant through the period as per the assumed depreciation schedule. Now, strengths and weakness in this statement that may concerning this venture. So we divided this, I divided this income statement in two concern. One part is strength, second part is weakness. So let us start from strength. Increase in sale initial years. The venture exhibits strong growth in sales during the first few years. reaching a peak in year 3 at $850,000. This indicates a potential successful market entry and acceptance of the product. Positive net income. With positive net income from year 2, the venture has the potential for profitability and sustainability. This bodes well for investors and stakeholders. Now we are going to discuss weakness for this income statement. Decline sales in late years. Prices decrease from $850,000 to $450,000 from year 3 to year 5. Posing long-term demand issue, risk, risk mitigation requires understanding these decline causes. Tax credits in year 1. While a tax credits in year 1 helps offset losses, it also implies that the venture might not generate positive taxable income in the early stages. Ensuring sustainable profitability for tax implication in criticals. Decreasing EBIT, income before income tax, decreasing EBIT. Decreasing EBIT decline from year 3 to year 5, suggesting operational issue or higher cost. Strategic planning requires investigation the cause of this deterioration. So now I'm going to the another aspects, working capital analysis for Fresnel Enterprises, INC. Working capital is crucial for assessing a company's operational liquidity and short-term financial health. The working capital analysis for Fresnel Enterprises INC venture in the smartphone screen guard industry is outlined as follows. Important aspects. I'm going to explain for working capital analysis. What are the important aspects? Number 1, working capital needs. Working capital needs respects the amount of capital required to fund day-to-day operation. The increasing to trend in the early years may suggest expanding business operation or increasing inventory levels to meet growing sales. Working capital change, WC. Working capital change shows annual working capital needs positive numbers raise working capital needs, whereas negative values reflects a release. The negative year for the negative year 5 change may suggest the negative year 5 change may suggest increased efficiency or lower inventory. This is in the 5th year. Final aspects for this working capital is recovery of working capital. In year 5, working capital recovery indicates a positive cash flow, showing that part of the working capital spent in prior year is being recouped. Increased receivables collection or inventory management efficiency may explain this. So now next we are going to discuss for strength and weakness for this working capital. So strength or weakness in this statement that may concerning to this venture. Firstly, we are going to start strengths. Positive income in year 2 to 5. The venture starts making money in year 2. This indicates the business can make money after expenses and taxes. Consistent selling and administrative expenses. The study selling and administrative expenses at $95,000 throughout the 5 years indicate cost management efficiency. This consistency allows for better financial planning and stability. Weakness. Now we are going to explain about weakness. Declining sales in year 3 to 5, sales drop from $850,000 to $450,000 from year 3 to year 5, raising worries about long-term demand. Understanding this decline causes is essential for risk mitigation. Negative EBIT in year 1 means negative earning before tax in year 1. In year 1, earning before tax was $67,500, indicating a financial setback. Tax credit reduced in the impact on net income, but recognizing the negative EBIT is crucial to business strategy. Weakness, the last weakness for this EBIT decreasing from year 3 to 5. EBIT decline from year 3 to year 5, suggesting operation issues or higher costs. Strategic planning requires investigating the cause of this deterioration. Now we are going to explain next aspects for Fresnel Enterprises INC for free cash flow. Let us start free cash flow. Equipment purchase calculation $67,500 negative value indicate a cash outflow, which means I have calculation we have minus 67,500. It's indicate that negative value indicates as a cash outflow. Interpretation: this Fresnel Enterprises initial project equipment purchase, its financial outflow and upfront expenses make it disadvantageous in the short run. Working capital investment calculation varied values ranging from minus $62,500 to $200,000. Interpretation: negative numbers indicate working capital recovery, freeing up cash. Positive value indicate higher working capital investment and possibly more short-term assets. Variation show working capital needs fluctuation throughout the time. Free cash flow calculation varied positive values from $19,175 to $449,375. In interpretation: positive free cash flow mean the venture is making more than enough to operate and grow. This is a good since it signifies cash for investors or business investments. This is free cash flow, which we explained for just before. Now I'm continuing discounted cash flow. Relationship with discounted cash flow measures. NPV, net present value. Calculation: NPV is calculated by discounting the future cash flow back to their present value and subtracting the initial investment. Relationship with discounted cash flow: by discounting future cash flow to the present value at a predetermined rate. NPV incorporate with DCF. Future dollars are worthless than present dollar, indicating money's temporal value. Benefit cash ratio calculation: BCR. I can say in short form benefit cash ratio, BCR. BCR is calculated by dividing the present value of future benefit cash inflows by the present value of cost cash outflows. Relationship with DCF: Since it analyzes benefit and cost, BCR uses the DCF principles. It compares the value created to cost, taking time worth of money into account. IRR, internal rate of return. I can internal rate of return I can call also IRR. So calculation IRR is the discounted rate that makes the present value of cash inflows equal to the present value of cash flows. So relationship with DCF. A DCF statistic IRR determines the discount rate at which the project NPV is zero. It accounts for times worth money represents represents the project's inherent return. Now, final slide is for formal recommendation for Fresnel regarding this venture. Formal recommendation. Let us start formal recommendation point one. After analyzing Fresnel Enterprises Inc. smartphone screen guard venture financial strength and weakness, I propose advancing with caution to address specific difficulties and leverage identified strength. Second formal recommendation. The business has a steady increase in sales in the first year, the consistent selling and administration expenses, and positive net income from year two. It appears that the product is popular and that corporation is managing its costs to make money. The third formal recommendation is, however, several issues must be solved. The year 3 to 5 sales fall merits more investigation of marketing dynamic competition and consumer preferences. Negative earning before tax EBT in year 1 and falling EBIT from year 3 to year 5 suggest first financial setback and possible operational issue. A fourth formal recommendation. Working capital analysis shows strength and limitation. The recovery of working capital in year 5 is positive, but the early working capital needs and net total working capital investment signal liquidity issues that must be controlled. Now, next formal repetition, which is number 5, net present value, benefit cost ratio. NPV stand for net present value, BCR stand for benefit cost ratio. An internal rate of return IRR support the venture. The positive NPV of $227,424.27 and BCR of 0.337 shows that the project will provide a significant value and financial efficiency. The 21.5% IRR, the 21.5% IRR is impressive and exceed the required rate of return. Despite hurdles, the financial analysis, the last and final recommendation, despite hurdles, the financial analysis reveals the venture has great success potential. Frenchel should analyze the market to see what is causing sales declines to improve project viability. Strategic strategic operational and marketing changes may be needed to overcome initial setback. The venture positive NPV, strong BCR, and remarkable IRR indicate that it's financially valuable and deserve pursuing with a strategic focus on vulnerabilities. This was our recommendation. And in the next, the final slides, you have a references as well. You can go through for that one. And this is so I hope you understand my presentation on financial information for Fresnel new venture and advice, and I try my best to explain about it. Thank you very much for spending such time to listen about my presentation. Uh, have a nice day. Thank you very much. Thank you very much. Thanks.